Hi, it's John Kelly. In this module, we are going to discuss Section 315 revised, Assessing Risk of Material Misstatement. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, with one big exception, there are no changes to this section. And indeed, the International Board may be of the opinion that they haven't changed the risk model at all. They've just clarified it. And indeed, there's a lot of editorial stuff done that doesn't really change anything. There are sections that have been shortened and lengthened. Sometimes the new standard is written for a very, very complex, very, very large entity, and we're going to have to apply the scalability provisions so that we can use those sections. But from an application point of view, and it depends on how you've been doing your audits in the past, with one big exception, there is no change in the section. And for instance, there are changes like internal control becomes the entity's system of internal control. And the applicable financial reporting framework is added everywhere. Those changes really don't change anything in the way we do the audit. The one big change is the addition of paragraph 34. If the auditor plans to test the operating effectiveness of controls, the auditor shall assess control risk. And before, you didn't have to, but you could assess control risk. Before, what you did was you did your risk assessment procedures and your D&I and operating effectiveness, and then you assessed the remaining risk of material misstatement and did substantive testing for that. Now, I always found that confusing, didn't quite understand how I might implement that in practice. It's not illogical, but I just didn't understand how I would do it in practice. And the other problem I had with it is if you do your risk assessment procedures and test operating effectiveness, and that's all you do for control, you've cut yourself off from the possibility of getting more evidence from testing control. Now, I will agree that often a systems walkthrough, testing the operating effectiveness, is all you're going to do to test internal control, and that will often be the case. But sometimes your audit strategy could allow for more testing of control, if that's something that makes sense. The other thing that's happened is inherent risk is rehabilitated. It's reintroduced to Section 315. That's a good thing. And inherent risk means the same thing as risk of material misstatement. The risk that the financial statements are wrong before the audit has been done, before we've tested control, and before we've done substantive testing. And it has to mean the same thing as risk of material misstatement. Otherwise, we get confused. And this is kind of proved in paragraph 34. Paragraph 34 says that if you don't test controls, risk of material misstatement is the same as inherent risk, and that is correct. That's right. However, one could become confused by the definition in standards of risk of material misstatement. The old section and the new section both say that risk of material misstatement has two components: inherent risk and control risk at the client. The risk that the client's controls won't catch it. And that can't be right from an audit point of view. It's right for the client, but it's wrong for the auditors, because we do not, in an audit, prove that the client's controls are as perfect as they are. We test less. We may have absolutely marvelous client controls and only do a little bit of testing and get a little bit of evidence. It also says that audit risk is a function of risk of material misstatement and detection risk. So again, we could get ourselves confused. The client's control risk is often very low, and it has to be, or there's no point in testing it. If client's controls are sort of good, or no good, or absent, there's absolutely no point in testing it, because what will probably come from our testing is we will prove that the client's controls aren't very good, and then we can't use them and we don't develop any audit evidence. So control risk A, control risk for the auditor, is a source of audit evidence, and we have a choice. If controls are good, we could choose not to test them at all. We could choose to test them some, a little bit, or test them a lot, which is often not efficient. But testing them not at all or some is going to be an efficiency decision, a strategy decision. How much do we want to test controls? How much do we want to test substantively? Now, standards could be read, and that's what they say, to mean that audit risk is inherent risk times control risk at the client times detection risk, and that's, of course, wrong. It must be that audit risk is inherent risk times control risk that the auditor proves times detection risk that the auditor proves. Now, just to put some numbers to this, and I wish this to be figurative, not literal, please don't take it perfectly mathematically. Please look at the math and then go, oh, I kind of get the general point there. So some people say that inherent risk at high is a 60% chance that things are wrong. Moderate, that's of course right, 50-50, must be 50%, and low, 40%. And of course, those numbers could all be different. It could be 61, it could be 83, it could be 49. And so audit risk is inherent risk times control risk auditor inquiry, inspection, observation, and reperformance, because there's 4 different ways we test control. And then we could do additional testing of control. So 1, 2, 3, 4, 5, 6. And then however many substantive tests we do, the first one, the second one, the third one. And that is how we develop audit risk. And we have to get that down to 5%. So purely mathematically, audit risk at 5%. So if inherent risk is low at 40%, and we do a systems walkthrough and we decide that that reduces things to 50%, and we do 2 not terribly good analytical procedures that also only reduce risk by 50%. Well, 0.4 times 0.5 times 0.5 times 0.5, ta-da, is 5%. And that indeed, I think, is the key message of the risk model, that if inherent risk is low, we don't really need to do a lot of work. And that perhaps our control testing, our systems walkthrough, and a couple of decent enough analytical procedures are enough. Now, I suspect that many auditors, because you're going to decide, I don't know, that it's not 40%, it's 41%, you're probably in most components, and there might be the occasional time you decide, you know what, my systems walkthrough, a couple of really good analytical procedures, I'm done. And that's acceptable. But you might also decide on a little or some more substantive testing, depending on where the spectrum of inherent risk you are. We'll talk about that in a sec. So revenues, inherent risk is low. We've done a systems walkthrough. We've got 2 really good analytical procedures. We're probably going to decide to do just a little substantive testing to make ourselves feel satisfied that we've done enough work on revenues. So control risk and detection risk from the auditor point of view are the same. They are sources of evidence. Testing controls is a source of evidence. Doing substantive testing is a source of evidence. And between the 2, strategically, we will pick a combination of the 2. We need to get sufficient appropriate audit evidence. So that's what we'll do. Now, control risk. Let's say we assess control risk at maximum. And we now need to do that because we're required to do that. We have to assess it at something. So if we assess it at maximum, we are getting no evidence. That's fine. And that's a strategic choice. Either controls are no good. And it's maybe they're absent. Long-term debt, small client, probably are no controls over long-term debt. We're probably not going to get any evidence of control of any audit evidence about long-term debt from control. We'll get it all substantively. So either they're no good or absent, or we just don't want to test them. We have a component that we've got a really good substantive test for, and we just don't need to do any control testing. That's fine. We might then assess control risk as moderate and get a moderate reduction in control risk. I call that a systems walkthrough, so we'll do D&I and O&E and do some testing. And that's certainly efficient, and often as we're doing our risk assessment procedures, we'll find that we've almost done all of that. So it's only a small additional amount of work to turn our risk assessment procedures into a systems walkthrough and get ourselves a little bit of evidence. Or we might assess control risk at lower than that or really low and get some more or a lot of evidence. The next thing we might do is look at corroboration, corroborate management's assertions, and that's a control test and might give us the evidence we want. Getting a lot of evidence from control, often a lot of work, and therefore often we're not going to do it. It's an audit strategy we're not going to select. And remember, as I said before, we test controls by inquiry, inspection, observation, and reperformance. And auditors tend to focus on reperformance. It produces marvelous documentation. You look at a file and go, oh, look, they did 30 items. Oh, that's so beautiful. Look at all those tick marks. My first observation is do not throw away the evidence you get from inquiry, inspection, and observation. Those are three valid ways of getting evidence. And deciding that you're going to get evidence only by reperformance is probably really inefficient. Indeed, getting evidence from reperformance or additional evidence of reperformance might just be inefficient in the first place, and there's some academic research that shows it's ineffective. There's non-sampling risk involved. Anyway, don't throw the first three out. So we're going to require documentation in all files now that looks something like this. And so for every component, and here's accounts receivable as an example, the first thing we're going to do as we do our risk assessment procedures is we are going to say, hey, I found a factor that affects accounts receivable. And it's very important that as you list the factor, you say what assertion it affects. Affects existence, for instance, or valuation. Here we have two unspecified factors, one that affects existence and one that affects valuation, because certain audit procedures address certain assertions, not all of them necessarily. Now, the wonderful thing about control testing is often, not always, but often a systems walkthrough will address all assertions equally. Substantive procedures tend not to. Substantive procedures tend to address a single assertion. Confirmation of accounts receivable affects the assertion of existence, not the assertion of valuation. So if you're worried about valuation, sending out confirmations won't help. And then the partner and the manager are supposed to think about and specify what they want to do in an audit and communicate to staff that weren't involved in those discussions what is to be done. So here's the place to do it. We say we're going to do a systems walkthrough to achieve a moderate reduction of control risk. And we're going to do this analytical procedure this way. Here's my expectation. And there we're going to specify what do we need to do for the two inherent risk of moderate things that we've specified. What do we need to do? What are the tests we're going to do? And that, by the way, if you think about it, if you say, well, I think it's moderate, and here's what I want to do in response to that, that will specify where you are on the spectrum of inherent risk. And also it provides communication to staff. So not all assertions have the same inherent and control risk, so it's important that we write this down. And for instance, cash in a domestic bank account probably has negligible risk evaluation and doesn't need any testing other than it's cash in a domestic bank account, so it's appropriately valued. Now, if you've never documented control risk before, this will be a big change, and you're going to have to change your audit methodology. If you did it before, as the International Board probably would assert, there's no change. You're just continue to do it the way you did it before, with a little bit of extra explanation in the section. Documentation, new paragraph 38, old paragraph 32. The wording is somewhat different, but in substance it's the same as before. They did not add an explicit requirement to document control risk, but I think it's implicit in paragraph 34. Design and implementation are still discussed in some detail separately. That's fine. But as a practical matter, when you're doing the audit, it's hard to do only design or only implementation and also at the same time not test operating effectiveness. And remember that inquiry and observation, for instance, which you're going to be doing as you think about design and implementation, are ways that you test operating effectiveness. So this is the same as it was before in a little bit more detail. As I said, sometimes they assume that systems are very complex. Paragraph 21 describes a vastly complex control environment. You could not use the standard as a checklist for all clients, though if you look at it closely, a lot of the times it says may, and may means the same as may not. So I think it's actually okay, but you just don't get scared off by the vastly complex language. And read paragraph A92, which talks about scalability and acknowledges that some or almost all entities will be less complex. So you just have to read your way through that. Don't be scared by the complexity of that paragraph, for instance. There's more detail on risk of material misstatement. One of the objectives was to provide more guidance on significant risk and what you did if there was a significant risk. They've actually taken a lot of those words out and said less. But I think the solution, and I quite like this, is they talk about a spectrum of risk. That risk is not high or moderate or low. It's slightly above low, slightly below moderate, slightly above high, really below high, really above high. And so you need to think about that. But as you develop that grid that we saw before, your specification of the procedures you're going to do and your description of the risk factor will document where you are on the spectrum, and that will solve your problem, and that you will do more than the normal amount of work for high because it's more than high. And also, think in audits, risk of material misstatement is rarely high. That's unusual, and if it is high, if it's a real big problem, you will know exactly what you need to do, and you will specify it and document it, so that'll be fine. So this is effective for year-end starting after December 2021. So that means it will be effective for a December 2022 year-end, which means this won't apply until 2023 audit. So it's quite a ways out. Lots of rewording of the section, but no real change. We're still going to audit the same way. And except for the requirement to assess control risk, no real change. So depending on how much of a change this is for you, you have until early 2023 to revise your audit approach. So thanks for listening.